So we all seen the news that we are currently in, and we can see two prevailing schools of thoughts. Buyers afraid to buy because it's going to be too expensive. Home prices have gone up and they don't know how they're going to be able to make their payments. Sellers afraid to sell because although maybe they bought their home 3-4 years ago, they want to upgrade now, right? They want to move into another home. Who knows what could have happened during those 3-4 years? People start families, families grow, people get divorced. Unfortunately, things change. Now they don't want to sell their home because they don't want to be faced with potentially a double rate than what they have when they first bought their home 3-4 years ago. So that's quite a dilemma. And so now if you're in the home buy market, I would suggest probably not waiting, right? If you have your ducks in a row, if you're ready to go ahead and pull that trigger, I would definitely do it, because home prices, from what I've read and the research that I've done, the gurus that I've followed and so on and so forth, none of them are really saying that the home prices are going to drop, and particularly anytime soon. What they are saying, and I believe to be the case as well, is that this year and probably going into the next couple of years, the value of the homes, or the rate of the value of the homes, is not going to be going up as quickly as we have seen the last couple of years. So what I've done here with this particular example, we're looking at a particular family. This is their income, expenses. The home is the debt. That's the only debt that they're going to carry, $220,533 with a cash flow of $769. Now, all the gurus will tell you, if you want to buy a home, right, go ahead and put 20% down on the home. And that's what you see here, 20% down. Their frame of thought, or their logic behind that in advising you to put 20% down, is so that you will have immediate equity when you make your home purchase. Well, my question is, what's good is equity if you can't tap into it, right? Equity that is inside the brick and mortar of your house is not going to serve you at all. Essentially, what you've done when you put that 20% down is give the bank a big, big tip, because they are now taking that money and investing it, right? And that's why it's better for you to retain that equity, put it to work for you in other things. But again, that takes a change of strategy and a change in thought process. So this number here, 220,000, then becomes the actual loan with the conventional way of doing things, right? So 220,533, 60 cents is 80%, right? 80% of the value of the home. Now, they'll also tell you, all the gurus, hey, go ahead and do that loan only for 15 years because we want you to pay that home off very, very quickly so that you can have money to be able to do other things as well. So that's the thought behind that. They want you to pay quickly. Here's the $250 for taxes that I included, and as well $75 insurance, which brings our total monthly payment, again, at a 15-year term. And then, by the way, I forgot to put this down. This is a 5.5 interest rate, right? I calculated that utilizing a 5.5 interest rate, which is an interest rate going now for a 15-year mortgage. There's actually more an efficient way for you to do this as a borrower, and I'm going to share that with you next. So with this strategy, we're still going to be using the 20% down payment that we use in the other strategy to buy the home. The big difference is we're going to finance this home purchase utilizing a first position HELOC. Now, many of the big banks, you're not going to find this deal with them. So you got to start shopping around. You got to start looking for somebody to work with that's looking out for you. But if you look at a lot of credit unions, if you look at a lot of smaller community banks, they tend to have that flexibility to help their clients in this particular matter. But if you notice, the 20% in the other loan, you gave it the day to the title company, cut out a check to them, they paid to the bank. That money's gone. You'll never see it again. If you wanted access to that equity, you have to refinance, or you have to get a second position HELOC to get that equity back. But with here, you're actually financing, utilizing the first position HELOC. What does that mean for you? Well, you're still going to have the same $220,533, 60%, which is 80% of the value, right? The home was listed at 275,667. So that's 80% of that. So nothing is changing in that regard. What is changing is how you're borrowing. And so here in Illinois, what I've done is I just looked at different credit unions that may be offering this type of loan for clients. And I found here in Illinois a credit union by the name of BCU. If you look up their website, it's actually bcu.org. I know they cover Illinois. I also think they do business out in Wisconsin. Minnesota might be there. And I think Indiana might be there as well. So again, I always encourage my clients, do your research on your area and see who's actually available with these types of HELOCs for you. So in either case, BCU right now, they are offering interest rate of 2.99%, and that's going to be for 3 months, right? So the first 3 months going into that loan, or to that HELOC rather, 2.99% is going to be the interest rate, right? What happens after those 3 months is they're offering, right, I'm looking at their website, as low as a 6.75%. So here we see a 6.75, which for this particular client shouldn't be an issue, right? They have no other debt, right? They have a decent enough cash flow to get them started. They've saved the down payment. They should be good to go. So 2.99% for the 3 months, 6.75, which is not too far from the 5.5 that we use on your typical loan to purchase the home with a 20% down payment. So what does that mean? That means that now they are able to put the payment that they would have made of $2,156.54, sending that to the mortgage company. Now it becomes cash flow to them, because if you've watched my channel for any length of time, you know that I encourage, when you use this strategy, you then use your home equity line as your checking account, meaning every week, every 2 weeks, if it's once a month, bonuses. Anytime you have any kind of cash flow coming into your personal economy, that cash flow is going to be applied to the balance of the home equity line of credit. So that's what that's going to do, is that's going to drop drastically how quickly the interest or the balance and interest rates get calculated with the home equity line of credit. Matter of fact, just with this particular payment, right? Now, this is not a mortgage payment. Remember, in this spending or in this expenses that they have, $3,921 was this for mortgage expense, which included, like we talked about, the taxes and insurance. They no longer have that, meaning that that is going to be considered cash flow, and when they apply it into the home equity line of credit, it's also considered a payment. But they already had $769 of cash flow to start with, right over here, $769, meaning that on a monthly basis, at the minimum, right, eventually it'll increase over time, but at the minimum, they'll have $2,925.54 of cash flow disposable available to them. So in a quick way, how to figure this out. If this was their cash flow at the end of every month, if this is where they started with the actual balance of the home equity line of credit, well, then we can do simple math. Take 220,533 divided by 292.54. You're going to get a number of 75 months. And if we do the math, we round it up, basically it's a little over 6 years, right? That's how long with this strategy it'll actually, give or take them to pay off this $220,533.60 home equity line. At the end of the 6 years, they have that home equity line disposable for them again to use for whatever it is that they need. And if you are a homeowner, you know that things happen all the time. You have to make repairs and do other kinds of things to the homes. It just happens, right? If you have kids, add another expense to that as well. You're going to take vacations. You're going to have, even if it's something that you just want to do in addition to the home, all of that can be done right through the same home equity line of credit. So don't lose hope. There are other ways that you can actually get in and buy your first home. And I hope that this really helps you to solidify that and really helps open your eyes to the opportunities that are out there. So don't get discouraged. Look for another way to do this. If you need help implementing this strategy, I would love to help you with that. My contact information is below. And if not, that's okay. Continue to like, subscribe, and share. You can definitely help out the channel grow in that regard. I definitely appreciate all your support. And into the next video, see you soon.